In 2026, something quietly historic happened in the global financial system. Gold and silver, assets that had survived wars, depressions, and the collapse of empires, began falling at the same moment. Government debt reached levels never seen before in modern history. The United States crossed $36 trillion in federal debt. Interest payments alone approached $1.2 trillion per year. And yet, markets were told everything was under control. But the real question is not what happened in 2026. The real question is how the world arrived at this exact moment. In 2026, the Federal Reserve made a decision that reshaped expectations around money, liquidity, and long-term stability. In 1931, Britain made the exact same decision when it abandoned the gold standard. The consequence was a global monetary reset. This is not speculation. This is over 2,000 years of documented monetary history. History has witnessed this precise sequence before. Again and again, powerful nations reach a financial crossroads. They accumulate too much debt. They promise stability they can no longer mathematically support. And then, when pressure becomes unbearable, they change the rules of money. To understand why gold and silver are crashing in 2026, it is necessary to go back, not decades, but centuries. For over 100 years, Britain's currency was backed by physical gold. In 1816, the United Kingdom formally adopted the gold standard. Every pound was tied to metal. Confidence was absolute. Capital flowed into London. By 1913, the British Empire controlled nearly 25% of the world's land and population. The pound was the world's reserve currency, but power has a cost. World War I shattered Britain's balance sheet. By 1918, British government debt had exploded to over 180% of GDP. Gold reserves declined, trade dominance weakened, and yet Britain tried to pretend nothing had changed. In 1925, Winston Churchill, then Chancellor of the Exchequer, made a fateful decision. He returned Britain to the gold standard at the pre-war exchange rate. The problem was simple but fatal. The British economy was no longer strong enough to support that valuation. British exports became too expensive. Unemployment surged above 10%. Deflation crushed wages. According to economic historian Barry I, the return to gold in 1925 overvalued the pound and strangled British industry. By 1931, investors began demanding gold instead of paper. The Bank of England hemorrhaged reserves, and in September 1931, Britain officially abandoned the gold standard. Within weeks, the pound lost 25% of its value. Japan followed in December 1931. The United States followed in 1933. The global monetary system collapsed in sequence. Notice the pattern. First came debt, then came artificial stability, then came reset. Rome followed the same logic centuries earlier. In 211 BC, the Roman denarius was over 90. By the 3rd century AD, it contained less than 5% silver. The empire debased its money to pay for wars, bureaucracy, and political survival. Prices exploded. Trust collapsed. According to historian Michael Russ, the decline of Rome was accompanied by a steady deterioration of its currency. Spain repeated the same mistake. In the 16th century, Spain controlled over 80% of global silver production from the Americas. Instead of strengthening the economy, Spain flooded Europe with metal-backed money it did not actually have in circulation. Prices in Spain rose over 400% between 1500 and 1650. According to historian Earl Hamilton, the influx of silver destabilized Spain's economy instead of enriching it. History does not repeat, but it rhymes with precision. Now, return to the modern world. Since 2008, the United States expanded its central bank balance sheet from under $1 trillion to over $9 trillion. Liquidity replaced discipline. Asset prices inflated. Gold rose from $700 in 2008 to over $2,400 by 2024. Silver moved from $9 to above $30, but in 2026, something changed. Markets began pricing in a new era of policy tightening. Kevin Warsh's influence on Federal Reserve leadership signaled a shift away from unlimited stimulus Real yields rose, the dollar strengthened, and metals fell. This is where the pattern becomes critical. Every empire in history collapses in 3 phases. Phase 1 is financial stress. Debt rises faster than income. Phase 2 is intervention. Governments manipulate money to delay consequences. Phase 3 is reset. The old system breaks, and a new one replaces it. Rome debased. Spain inflated. Britain abandoned gold. The United States is now navigating the same structural dilemma. Consider the metrics. Rome's silver content fell from 95% to under 5% before collapse. Spain's inflation exceeded 400%. Britain's pound fell 25% within weeks of leaving gold. Weimar Germany saw prices double every 3 days in 1923. The United States has not reached hyperinflation, but its money supply expanded over 40% between 2020 and 2022. Its interest burden doubled in 4 years. Its D2 GDP is projected to exceed 125% by 2030. According to the Congressional Budget Office, interest costs will soon exceed defense, Medicare, and infrastructure spending combined. Gold and silver are not crashing because the system is stable. They are adjusting because the system is changing. Most people won't see this pattern until it appears in retrospective analysis. If we understand the historical precedent, the next phase becomes predictable. History reveals 3 outcomes. The rare outcome, about 10% of cases, is reform without collapse. The most common outcome, about 70%, is long stagnation. The worst-case outcome, about 20%, is reset through crisis. This is not theory. This is over 2,000 years of monetary history. Empires do not fall because of politics. They fall because of math. And when money changes, power changes with it. If you want to understand these patterns before they unfold in real time, subscribe. New historical analysis every week.